Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Dave Mazza, Managing Director at Direxion. Direxion is one of the largest issuers of leverage and inverse ETFs. They also have some very interesting thematic and relative weight ETFs. Dave, welcome and thanks for joining us today.
Thanks very much for having me.
So I wanted to start with the broader markets, and we know that major indexes have rebounded strongly from coronavirus-induced sharp sell-off in late February and March. This is despite rising number of coronavirus infections, but thanks mainly to this unprecedented fiscal and monetary stimulus, and also some very encouraging developments in the race for coronavirus vaccines and treatments. And this rally has been led mainly by tech stocks that benefit from this environment and this health crisis. And now, of course, investors are focusing on earnings. And earnings have not been bad so far, and that is because the bar was so low. So I was interested in your thoughts on the stock market performance so far this year.
Well, I think you hit the nail on the head. On one hand, it's been quite confusing for many investors, because if you focus on the news and the economic data, even understanding the massive stimulus, both monetary and fiscal, to your point, that has come, things are difficult from a health situation, from an economic situation. But markets have, when they bottomed at the end of March, it's been a very relatively smooth ride, back to positive territory, if not well above positive territory, looking at areas like the NASDAQ. But much of it has come from one sector, tech, and some tech plus type names as well. And really, one of the reasons why, and one of the reasons they're driving the market higher, is first, simply that's where the growth is. We know earnings are going to be pretty abysmal for many areas of the market, but technology companies in some ways have shown a lot of resiliency to that, both on the consumer side and on the business side, because what this pandemic is doing is really continuing to transform and accelerate some of the trends that were already in place, much of those being driven, again, on the tech side. So, we're at an interesting juncture here from a market perspective, because now valuations are looking a lot richer than, of course, they did in the depths of March, and earnings surprises and guidance for the second half of 2020 and into 2021, are going to be extremely important, because many names have begun to trade at such rich multiples that if they're not able to actually deliver on some of those earnings expectations, those stocks may suffer. But our guess is that, again, those areas that have been doing well will show that resiliency, and that will come through with earnings this quarter and then likely into the rest of the year.
Excellent points. Now, I wanted to talk about some of the leverage ETFs, and because these leverage ETFs are great indicators of market sentiment. And so now, not surprisingly, internet ETFs, leverage internet ETFs, they are among the top performers this year, because thanks to this health crisis, we have seen about 6 years worth of digitization in just 6 months. So Direxion Dow Jones Internet Bull 3 times, ETF ticker symbol WEBL, WEBL, and Direxion CSI China Internet Index ETF, that's 2x CWEB. They are both up more than 60% this year. Tell us about those ETFs, and do you expect that performance to continue?
Yeah, you raise a great point. Our leverage and inverse ETFs are geared toward tactical traders, who are attuned to market opportunities, both on the bull and the bear side. But two of the funds that have had some very strong performance this year, even subject to some of the drawdown that we saw, are focused on the internet side. One, WEBL, is more focused on U.S. companies, and then CWEB is more focused on Chinese companies. And so, these ETFs are really intended to, again, provide that exposure on a daily basis. So this has been an example where there's been positive compounding. But of course, there can be negative compounding. Investors do need to be aware of the risks of investing or trading leveraged and inverse ETFs. But in this particular case, because internet stocks, again, whether especially those coming out of those based in China and of course in the U.S. have done really well. So if I think about the Dow Jones Internet Index, top names are Amazon, Facebook, Netflix, PayPal, and Cisco. And then, of course, going down the line, you'd see many more names, whether they're software as a service names or B2B names that have done quite well. And then on the CSI China Internet Index side, there's your Alibaba and your Tencent. These are household names, of course, both in China, but in the U.S. market as well. And investors have looked for any opportunity for growth. And that's kind of also played out with the trading community. So yeah, we've seen these ETFs have exceptionally strong performance because they've actually rallied with low volatility. So the benefits of compounding have been positive in this particular case. Excellent.
Now, since you talk about compounding, I wanted to ask a question about that. And as we discussed, technology is the best performing sector this year. The rally has been led by technology stocks, Apple, Microsoft, NVIDIA. They have done so well this year. So that is why XLK, the technology sector spider ETF, is up over 18% this year. But DECL, which is Direxion Daily Technology Bull 3X ETF, this is up only about 10% year to date. So I think this is a perfect example to explain how investors should use leveraged and inverse ETFs in their portfolios, particularly during volatile market environments. So tell us about that.
Yeah, no, it's a really important point, and one that we are proud providers of these particular products, but we want traders to understand investors how to use them appropriately. So on paper, two similar indices. They share actually some similar holdings. If we look at the internet versus broader technology, but performance will always go back to the particular holdings that are in an ETF. Whether that's a single beta ETF or bull and bear leveraged ETFs. And again, on the internet side, more concentrated on this broad concept of internet. So Amazon, Facebook, Netflix, even PayPal, et cetera. Of course, the broader tech sector, there is, your top holdings are Microsoft, Apple, Visa, MasterCard, right? All have done well. But what's interesting is if we go back to, again, thinking about that drawdown period, primarily from mid-February to mid-March, they actually had somewhat similar performance. Here, WEBL and TechL, to use those examples. But since then, there was greater volatility for the broader tech sector than just those internet names. So the bull fund on the tech side suffered from negative compounding. So while, again, on the internet side, positive compounding. So we really... investors need to understand that these are intended to be daily trading tools. So you have to understand that we're going to reset the exposure on buying and selling, regardless of what the market does, based off of what the mandate of the fund is to do. So you have to stay attuned to again, what is the underlying exposures? How may they be impacted by particular environments? Because these funds that may seem similar could have varying performance depending upon what's happening in the underlying volatility of the securities that are represented in the index.
That is very helpful. Investors should always remember that these ETFs reset on a daily basis, and their performance can differ significantly from their stated performance objectives, daily performance objectives, if they are held for a longer period. And as you explained, compounding can have both favorable and adverse effects. So in case of WEBL, we saw favorable impact, and in case of TechL, we saw adverse impact on the returns. Now, I wanted to talk a little bit about your relative weight ETFs. So last year, Direxion launched a suite of relative weight ETFs that basically allow investors to capture both sides of an expressed view. And I noticed that some of your relative weight ETFs have done pretty well this year. For example, Direxion Russell 1000 Growth Over Value ETF, ticker symbol RWGV, and Direxion Cyclicals Over Defensive ETF, ticker symbol RWCD. So tell us a little bit about those ETFs. Do you expect those trends to continue? And also what investors need to know about that suite of ETFs. Unlike your leverage and inverse ETFs, can these ETFs be held for a longer period of time in investor portfolios?
Yeah, I'll start with the last part of your question first. So our relative weight suite of ETFs are actually 150/50 ETFs. So what that means is that in every ETF, there's 150% exposure, which is long, but balanced with 50% short exposure. So it's a capital efficient structure. For every dollar, there's $2 expressed, 150 positive, balanced with that 50% short. And the reason we structured them in this way is that while there's gross leverage, there's no net leverage. So an investor can hold these for longer periods, whether it's a month, a year, or 10 years if someone has a particular view. But these are intended for investors with views, meaning as an investor, I believe that growth is going to outperform value, or I believe that value is going to outperform growth. And so as examples, so the benefit would be that unlike a traditional long-only exposure, where when you are making that decision to own a growth ETF, you're likely saying, well, I think growth is going to beat the market and by nature beat value. But this structure allows an investor to not just benefit from their call potentially being correct, and in this case, this year, as we know, growth has trounced value tremendously. But now they can benefit from capturing part of that spread between those growth stocks beating value stocks. So yeah, we've seen our fund RWGV have tremendous performance this year relative to broader growth funds, both active and passive, or even defined in a more smart beta way, because you're amplifying your exposure to growth funded by a short to value. So, over this time, again, we've seen unprecedented performance of growth stocks relative to value stocks as investors have paid up the higher multiples for growth because that's where the potential for earnings can be, coupled with the fact that value stocks in this environment are really filled with financials and energy. We know they've seen some pockets of better performance lately, but many of those names are facing some structural headwinds, whether it's the low interest rate environment with financials or the question marks about the significant amount of reserves that oil reserves that energy companies have when the price of oil may be nowhere near $80 or even $100 a barrel for a long time. So they're really great tools for investors who are looking to express these views. And we've started, and you noted another fund, RWCD. This takes the group of cyclical sectors relative to defensive sectors. So there, unlike growth, you would have on the long side value stocks coupled with tech stocks. That's really it has not done as well as just that growth over value. It's still done well because it's more intended to just give me that cyclical, but I would like to short the more defensive names in that particular case. And so we structured these as pairs. We have growth over value, but if you want to take the opposite, we have RWVG, which is value over growth. And so we have these pairs in large and small. I said, as I noted, cyclical, defensive, and even international exposure. So U.S. over international, or international over U.S., and emerging markets over developed, and developed markets over emerging. So really something for everyone when thinking about where opportunity sets may be. From an interest perspective, we've clearly seen the most interest in growth over value, but also recently in value over growth, as we've seen investors dip their toe back in and be more comfortable, taking that contrarian view that now might be the time that value is going to finally come back.
Excellent. Definitely a very interesting suite of ETFs and great performance too. Now, I wanted to talk about your newest ETF, It is the Direxion Work from Home ETF, and ticker symbol is WFH. Couldn't have been better. Very, very appropriate. So we know that this crisis and stay-at-home, work from home environment that has accelerated many trends from cloud computing, cybersecurity, e-commerce to digital payments. And these trends are expected to continue for some time, even after the pandemic. So tell us a little bit about this ETF and why you decided to launch this ETF.
Well, you used a great term a few moments ago, 6 years and 6 months. And I think about it the same way. This pandemic, if we take a step back from the health concerns and the economic impact and people losing their jobs and say, what are going to be some of the lasting trends? Even if we were to have some magic vaccine in a short period of time, what will this accelerate? And to me, one of those trends is the trend toward greater acceptance of remote work. And I think we've been in this environment where we think, well, we're either working in an office or we're working in our home because we've been forced to be. But again, the idea of remote work is more having greater accessibility, having greater flexibility. And what we've actually seen, if you look at the data, 54% of CFOs very recently have said for roles that allow it, they're thinking about making remote work permanent. And you'd say, well, that's absurd. That's crazy. Why? Well, what companies have found is that barring maybe childcare issues, productivity's actually been quite high for certain roles. Maybe people are less distracted. There's less of a commute. They can just focus on their job and work from the comfort of their couch or their home office. So there's a lot of accelerants from the top down. But we're also hearing this from the bottom up, especially with younger generations, millennial and Gen Z in particular. When we look at studies and surveys of that generation, they're so tech-enabled. It's just been a part of their life, especially Gen Z. So they view work differently. It doesn't just have to be done in an office. So flexible approaches, meaning either full-time remote work or hybrid type models, partially in the office, partially remotely, will likely become much greater norm going forward. Again, because if companies want to attract a diverse workforce, the best type of employees, they're going to need to play into what people's preferences are. So if this millennial mindset potentially could become a win-win for companies.
Excellent. I agree with you. Remote working trend is here to stay. So tell us how holdings are selected and weighted in the index that this ETF tracks.
Sure. So work from home tracks the Selective Remote Work Index. And what that index is intended to do is capture 4 established and emerging technological pillars that are powering the technologies required to have effective remote work. So those start with cloud companies. So we know there's a need for data to be securely stored and accessed. And along with that is cybersecurity. So when you have data on the cloud, employees in disparate locations, there's potential for greater cyber threats. So we believe cybersecurity names will benefit from this trend. And then when it comes to what are companies and employees actually doing, there's your online project and document management firms. So those are the companies that provide the applications to manage projects and collaborate across teams, wherever those teams may be located. And then remote communications, that's your video conferencing, instant messaging, email, and the like. I think that's the really what most people think about for remote work trends. But again, it's really the combined approach. It's what are the actual tools that we need to be efficient and effective with remote work, but what are the kind of tools that provide air cover, like cloud and cybersecurity. So what this index does is it seeks out the 10 stocks in each of those 4 pillars that provide the greatest exposure using some AI type tools to identify them. And so 10 stocks, 4 pillars, 40 stocks total, and they're equally weighted at every semi-annual rebalance. So we'll continually be identifying those companies that are most relevant to those particular sub-themes.
Excellent. Now, I'm looking at some of the holdings in the CTF, and you mentioned that these are equal weighted, but some of these are very familiar companies, and they make a lot of sense why they are there. For example, Google, Adobe, Amazon, but there's some companies, some of these holdings our listeners may not be very familiar with. For example, 8x8, and there's a company called Avaya, Atlassian. Would you like to talk about some of these top holdings and why you like them?
Yeah, you raised a great point. One of the best things about this particular ETF, and of course, I'll admit I'm biased, is exactly that. Is that in this portfolio, you're going to see names that you know. Of course, on the cloud side, it would be a mistake not to have Microsoft, Amazon, IBM representing cloud because they are such large providers and players in that particular space. But if we think about remote communications, a great example is everyone thinks of Zoom Video. We know the stock has had unbelievable performance. We know it continues to be one of the most downloaded apps, according to sources like App Annie and others, both for business and for personal use. But you're also going to see a name in remote communications like Twilio, ticker TWLO. And what Twilio actually does is you might be using Twilio already and you don't know it because they power the ability for other companies to send you an SMS message to prompt you to do something, maybe pay a bill or a reminder like that, or a doctor's appointment. They'll also provide the technology to make those calls. So New York City has actually contracted with them to build the contact tracing app that's they're using for COVID-19. So, this company is providing a technology that if you were just simply looking for the most obvious names, you wouldn't find. And, we have these examples across the board, to your point. So, when we think about something like project and document management, of course, the G Suite from Google is going to come to mind. But there's also companies like Dropbox and Box who, are providing collaboration tools and online storage that some people might be familiar with, but not everyone. So, again, the names in here are intended to capture those established companies that may be obvious, but also the emerging ones or the ones that are powering the technologies that other tech companies are using, so that you can get the full perspective of what are those most relevant 40 stocks powering the work from home revolution.
Excellent. Some very interesting companies for sure. Anything else investors need to know about the CTF or any other particular Direxion ETF you want to talk about?
Well, yeah, one thing I would say for this ETF or any of our leveraged inverse ETFs, we just actually launched a new website. It's still at www.direxion.com, but brand new website, significant amount of educational material for traders to understand how to use leveraged and inverse ETFs, or some really great statistics and data on trends like work from home, blog posts, and the like. So I'd encourage anyone looking for more information to please visit our new website.
Sure, very interesting, and congratulations on the successful launch of WFH. That's all we have time for today. Dave, thanks so much for joining us today.
Thank you very much.
Thanks for listening. Please visit the ETF section of Zacks.com to learn more about these ETFs and many other interesting ETFs and ETF trends. Make sure to be on the lookout for the next edition of ETF Spotlight, and also make sure to subscribe. If you have any comments or questions, please email podcast@Zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.